Welcome, first of all, to everyone who came tonight, and thank you so much. I'm Jeff Kirby with Discovery Anesthesia, joined by my partners, Matrina Whitley and Parker. And for those of you who don't know us already, Discovery Anesthesia, we are a small CRNA-owned CE company built by CRNAs for CRNAs. We provide continuing education credits online so that you can do them anywhere, anytime. You can take us with you on your vacations and get your CE credits however many you need. We have several different options, several different formats, so we try to keep it interesting for you. With that said, I'm going to turn you over to Jennifer Parker. Go ahead.
All right. Okay, so I'm going to introduce our speaker tonight. We're joined by Ben Barnhart. He's a certified financial planner and an IRS enrolled agent. He's the founder of On Point CRNA, Barnhart Wealth Management. Ben is CRNA focused. He's a CRNA focused financial planner who works with anesthesia professionals across the country. And he's also married to a CRNA, so he genuinely understands the 1099 world that we're living in. So Ben, welcome. Thank you for joining us tonight.
She's been a CRNA for many years, and she's asking, sorry, I just accidentally scrolled past it. Give me 1 second. I apologize. But she said, basically, she's been a 1099 CRNA. I'm sorry, a W-2 CRNA for many years. Her husband is the main earner in the house, and she's switching to 1099 now. And she wanted to know, I apologize. Give me 1 second. I just want to get this question right. So she says she'll work, obviously, her husband's the high income earner who will provide the health insurance. So she's trying to decide between sole proprietor versus corp.
Gotcha. So those are in a vacuum. The decision with the health insurance doesn't really impact anything as far as S-Corp versus sole proprietor. The whole idea with the S-Corp is you're trying to reduce how much you pay in payroll taxes. So different for Beth, I think you said her name was, different for her. The big change is going to be for 2020, first $184,000 in some change is how we assess Social Security and Medicare taxes. When you work W-2, the hospital covers half of it. You cover as the employee the other half. So you pay 7.65%. The hospital pays 7.65%. Only on the first 184 grand. I think it's 184.5 this year. With your husband's income, completely separate. You each have your own respective 184.5. So with you going 1099, the whole idea with the S-Corp is you can pay yourself a wage that is less than the 184.5. Let's say, just for argument's sake, let's say you pay yourself $150,000 salary. Well, now because you're 1099, you're paying both halves of that payroll tax. So it's 7.65 times 2, it's 15.3%. By you paying yourself a salary of $150,000, you're essentially avoiding paying those payroll taxes on that additional $34,000. That would amount to $5,200 in tax savings. That's the benefit of doing the S-Corp, and that's why most 1099 CRNAs have one. So for you being full-time, 9 times out of 10, it's going to make sense for you to do the S-Corp as long as that fair and reasonable wage that you can justify is less than the 184.
Am I next or Matrina?
I think you go.
Okay.
Yep.
So this is more in reference to something we talked about last week. They would like to know if you could review more on an accountable plan, and if possible, provide an example accountable plan.
Absolutely. We can send that out too. I have a spreadsheet that we use with clients. An accountable plan, the IRS says that because you are a more than 2% shareholder, and first to clarify, you only need the accountable plan when you're an S-Corp. If you're not an S-Corp and you're a sole proprietor, you can write off things like your home office and your mileage and reimbursement for like your cell phone expenses or internet, things that are mixed business use, anything that's not 100% for your anesthesia work. You have the ability when you're a sole proprietor, you don't have to do anything special throughout the year. You can write it off all at the end of the year. You just total it all up. You put it on your tax return. The accountable plan is a little bit different because you're more than a 2% or greater shareholder. When you pay yourself as an employee, you have to have a system in place for how you reimburse employee expenses. That's where this accountable plan comes into play. And the IRS says it has to be done in a systematic, defined way, has to be in writing, which is pretty straightforward. It just outlines how frequently you do it and what you're going to do as far as that. And then I have a spreadsheet, and I can share my screen here real quick just to walk through how it works. We like to do it quarterly. So at the end of the quarter, you would just log in. Everybody should be able to see accountable plan. So, and I'm going to zoom in for everybody here as well. So it's pretty straightforward. You're just using this to to account for all the stuff you're about to reimburse yourself for. So for the first quarter, you would go through and all right, we've got a 2,000 square foot house and my office is 200 square foot of it. So now every expense here, cleaning fees, gas costs, water, HOA dues, homeowners insurance, you get the idea, right? So we're going to populate all of these things. And I'm just putting in numbers just to show you guys. 10% of all of these costs now, we can reimburse ourselves. I'm going to make it more realistic numbers. So for this quarter, you would be able to reimburse yourself $1,300. This is just to keep track of it. You also have some vehicle expenses. We're just going to take the higher of whether it's the actual expenses or the mileage driven, and then part of your home and internet use, phone and internet. And then you also get to take a portion of depreciation on your home office as well. So there's just some formulaic stuff in here to help make calculating it easy. You get to the bottom, tabulates it all out. 47, you're going to move that from your business account to your personal account and categorize it as an employee reimbursement. You do that every quarter. That's how the accountable plan works. If you're ever audited, you're able to now take these expenses on your business tax return that you otherwise wouldn't have been able to take.
All right.
Well, I think that answers the question. Well, I have that as a template. We can send that out, afterwards.
Yeah, that'd be great. Thank you.
Someone else is wondering, can a traditional IRA be converted to a solo 401k?
Yes. Yep. So I have and I can put this in the follow-up sub too. I have a really great article that I have written on reverse rollovers. So to preserve your backdoor Roth eligibility, what you can do is take pre-tax money that's outside of your employer-sponsored plan, do a reverse rollover. There's no taxes. There's no penalties on it. You're moving it from one pre-tax pocket to the other pre-tax pocket. The reason you would do that, you invest in all the same stuff. There's no difference other than now you don't have pre-tax money outside of an employer-sponsored plan because it's all inside the solo 401k. Preserves your eligibility to do the backdoor Roth.
The next one, they ask, if my husband has work insurance for all of us, can I opt out to do HSA for just me to save money?
Yes, as long as you have a high deductible health plan. If the deductible is high enough, you'd have to get your own health insurance separately, and then you'd have to have a high deductible health plan.
So there's a little work involved there to make that work.
Yeah, there's a nuance there. The juice probably isn't worth the squeeze, so to speak.
Okay, so
it's going to be way more expensive than what you'd save in taxes to get on your own health insurance. I'd say on his workplace plan because the employer's covering a lot of it. As 1099 contractors know, the health insurance is not cheap.
Okay, we have another question here from Adrian, and she said that her husband has business partners and an S-Corp plus multiple states we file in part W-2 and part 1099. How can we maximize his S-Corp and my 1099 income? It's kind of a broad question, but
Yeah, so maximizing the S-Corp, when you have other shareholders, it gets a little bit more hairy because you're not the only, the sole income earner inside the S-Corp. For her specific, again, the S-Corp's all about avoiding the payroll taxes, completely separate from him. Each of you have your own respective amount you have to pay into the system each year up to that 184.5. So the question would be for her, how is her split between W-2 and 1099? Meaning if she's already going to make, let's say 150 grand W-2 and then make 150 grand 1099, it's probably a moot point to jump through all the hoops with the S-Corp because she's already eaten up most of that Social Security wage base. And then if we pay her a salary through the S-Corp, now she's over it. And it's a lot of hoops to jump through. As much as an accountant would want to charge you for an additional tax return, it's probably not worth it.
Isabel asks, how do you properly deduct travel between multiple rural hospitals? She said, we are 2 CRNAs covering several rural hospitals.
Yeah. So as far as the travel, there's going to be an overnight portion to it, as far as like per diem reimbursement. Depends on where they're at. Basically, the IRS has a formula for every zip code that you get to take an automatic amount for meals and travel and stuff. The main thing for them is going to be trying to evaluate if they're rural. Sounds like they're probably driving and not. I had a client last year that lived in Michigan, flew to Oregon. 3 weeks at a time, and then she would fly back for a week. That's all deductible. It's for work. When you're driving to these different places, the way we like to do it is have you take. Technically, you're not supposed to be able to write off commuting miles. We like to set it up so your home office, when you walk down the stairs, from your bedroom to your office, you just commuted to work. Now, all the mileage that you drive to these different rural places is deductible. And then it's just a big math problem. Are you driving? The choices there are, if you're driving a ton of miles and you have a cheap car that you're driving, the mileage deduction probably comes out ahead. Versus if you're not driving a ton of miles and you have an expensive car, probably should buy the car and take the depreciation, or have a lease payment where you get to write off gas and insurance and everything. All we do at the end of the year is we just evaluate which is more beneficial to you. The thing that you have to do now, and we've had CRNAs go through this, the IRS is going to ask you to reproduce a mileage log. So you need to keep track of, which if you're driving to the same place every day, it's pretty easy to determine, right? Hey, I work this many days. I take the same way to work every day. What we have to figure out is your business use percentage. So you drove 10,000 miles this year total, 7,000 of them were for business. 70% of all your actual expenses, or 7,000 miles, is what you're going to be able to take. Whichever gets you the bigger deduction is the one we should take.
Okay.
Yep.
This next one, Ben, is kind of a big question. There's a lot to unpack here. So if you want to break this up a bit,
Yeah.
I'll run through it all and then we can kind of go from there. But this person says they're contemplating doing locums and being a paid 1099 exclusively. Currently, they're W-2 with a $300K salary. They supplement with an LLC 1099, making about 80. They fully fund their 403B, and catch up, they say, has to be a Roth. This person's 53. They also fund a 457B with about 23.5, and fund some SEP IRA that they started with their LLC.
Yeah.
They go on to say W-2 company gives them another 15 to 16K for retirement compensation toward the 403B. So by going 1099 locum exclusive, assuming their pay is 400K, how much can they put towards retirement and still get paid more than the W-2 job right now?
Okay. Lot to unpack. So you want me to do a full financial plan on the? It's a great question. So first of all, it's great that they're trying to hammer money away pre-tax. First thing that jumped out to me, they shouldn't have a SEP IRA. They should have a solo 401k. They're already pulling all the pre-tax levers. They can still do the 25% additional contribution, but then everything else up to the total $72,000 limit this year, they could do as an after-tax contribution, which they can't do with the SEP as that mega backdoor Roth strategy. So that would be the first thing. They could tweak that. If I understand her question correctly, she wants to know if I'm going to work the same amount of hours this year, what would my rate need to be in 1099 work to have me come out ahead? To just go completely 1099. Am I understanding that right?
I think so. Saying she's going to be, like, if she went complete 1099, she's figuring that on 400K annually.
Okay. And she would have otherwise only been at 380.
Well, roughly, yeah. With all those numbers, yeah.
So she's going to make another 20 grand. Does she come out ahead after all, like the tax benefits and everything?
Yeah.
I guess I would tell her to set up a meeting with me, just because there's going to be, I have a template. I'm trying to pull it up right now that I love this question. We have CRNAs reach out to us all the time. Like I can tell her to the penny if she's going to come out ahead or not. Yeah. It's just tough because there's a lot of,
she goes on. Go ahead. Sorry.
Boom. Okay. So this would be an example of one that we did recently with a client trying to evaluate full-time 1099 versus W-2. And then he had another hospital he was trying to evaluate. So just kind of breaking down the assumptions between hours worked. Now you're not getting paid vacation. Basically want to just level set, make them apples to apples. Now, if you go full 1099, you're going to miss your insurance. You got to usually cover your own malpractice. You got additional tax prep fees potentially, or payroll costs. You're paying more in overall FICA or payroll taxes because now you're covering both halves, not just one half. But then it opens up kind of Pandora's box of stuff you can write off. You get a QBI deduction. max out depending on how aggressive you want to be with retirement contributions. So for this particular client, he was making 400 W-2, and this was at U of M. And compared to this other 1099 rate, if he was going to work the same, this is screwed up. There we go. Working the same amount of hours per week. Actually, it wasn't screwed up. He also had some 1099 work with Toledo here with a 1099. So apples to apples, the cost of 1099 was more. Total benefits, usually the dollar per hour comes out way ahead. So for her, only being 20 grand more in gross income doesn't sound like she's probably going to come out too far ahead on. Usually it's a slam dunk because obviously this rate goes from 138 to 250. Huge difference.
Sure.
Huge difference. And then not only like you get more benefits and everything. So I'd be happy if she wants to set up a meeting, I'd be happy to like help her plug stuff in. This is available for download on the website as well.
All right. Thanks for answering that.
All right. Are we still on the text thread, right? Jeff, where did you get that question from?
That's the first one of the big, the huge big one. So the next one is the 0900 one. It says, I'm not sure if you have
You
any.
go ahead and ask it because I'm not sure.
Okay, this says the next question, Ben, is I'm not sure if you have any knowledge regarding this topic or not, but regarding retirement accounts for a 1099, is it better to fund a SEP IRA, which I believe you kind of just answered, or a solo 401k account, and why one over the other?
Yeah. So great question. And to back up, this was for a 1099, like 100% 1099.
Yeah.
Okay, so let me do this. Let me share this. All right. Everybody should be able to see a black screen now.
Yep.
Okay, so I'm going to break down the two real quick. We got a SEP, we got a solo 401k. Let's say, make argument or everything easy. Let's say you have an S-Corp and you're paying yourself $150,000 salary in both examples. The SEP IRA, all you can do is 25%. So 37.5. That's the most you can put away across the board. That's all you can do. Solo 401k, you could do 24.5 as the employee. Then you can give yourself a 25% profit sharing as the employer, which is that 37.5. These both add up to 62 grand. Now, the cool part with the solo 401ks that we like to set up is it also allows this other after tax contribution. And this allows us to execute that mega backdoor Roth strategy. So they could do an additional, the most you can put away across all plans in 2026 is 72 grand. So what they could do, this after tax contribution, we could do an additional 10 grand as an after tax contribution and then immediately convert that to your Roth. So hammer away a lot more money pre-tax and after tax. Solo 401ks is definitely the way to go. So I'm more visual. It just helps to otherwise be talking with my hands the whole time here.
No, for sure. That's awesome.
Do you have one, Jen?
No, go ahead, Matrina.
Okay. Can you talk about reporting year-end assets of solo 401k to the IRS? I have heard of CPAs charging a lot to do this for clients, yet the form 5500 doesn't look complicated.
It is easy. It's easy.
Hence the name.
Yeah. It's a one-page form. It's due in like July, I think. You just take the balance from the, December 31st, any contributions or rollovers that you made in the plan based on the EIN, and it's very straightforward. That's not a pretty heavy lift. I mean, if you use something like mysolo401k.com or a third-party administrator, that's usually included in there. I think they charged $150 a year or something.
Okay, go back to you, Jeff.
All right. Courtney asks if you have a recommendation on the best credit card company to use for your business purchases or how to go about making that decision.
I see this one all the time. There really isn't one. I mean, think about it this way. How much in expenses do you really have in business expenses? Most CRNAs, most 1099 CRNAs, $5 grand a year, right? 10 grand a year at most. Okay, so we're talking about a 1.5% back credit card compared to a 2% back credit card. It's $150 a year credit card rewards. You've probably already spent way too much time thinking about it already. Like I would just pick a card where your bank's at. You're not funneling a ton of money through there. If you want to try to qualify for like a sign-up bonus, that would be the best way to leverage credit cards. I love playing that game. We're opening a card, closing a card, trying to get the bonus. That's where the juice is worth the squeeze on credit cards. It's not the cashback portal stuff. It's the benefits you get. The Amex Platinum card has a $900 fee. You spend through your business, you got to spend 20 grand on it in 6 months, and they'll give you 150,000 points that you could redeem through their portal for $3 grand. That's the value. It's not the 1% that they're going to give you back. But then you got a $900 fee every year. So it's like, then you close it, then you get another one. That's the game to play if you want to play it. But yeah.
Let me couple onto that real
Yeah,
quick. If does it matter if you have, let's say, a bank related credit card versus like let's say you use your Delta Reserve card? Does it matter if it goes into if it's a bank related to your business account versus a personal credit card for your business expenses?
Yeah. So you should, separation of church and state, only be funneling business expenses through it, which again, as a CRNA, makes a $20,000 spend in 6 months. Kind of tough. Unless you know you're going to buy a bunch of CE from Discovery Anesthesia or, whatever it is, buy a laptop, business, you're going to travel, you're going to fly to Atlantis to do the Bahamas, whatever. I know that's a big one down there every year for CE stuff. You would have to be very intentional about that. Ultimately, it's to your point, you're going to travel a lot, get the Delta card, the business Delta card then, and you're going to get your free companion certificate every year, whatever it is. That's how to optimize credit cards. It's not cashback performance stuff. Just because you're not funneling enough through it every year.
So with using a personal credit card, you're kind of worried about like that corporate veil thing or no?
That would be the big thing, is the corporate veil. The other thing too is if it's a business credit card, that $900 fee we can write off as a finance expense. So maybe it doesn't actually cost $900 in real money, costs $600 after taxes. And then any benefits, the IRS views credit card reward points as tax-free benefits because you had to spend it to get it, basically. So any of those benefits you receive, like I think on the Amex, one of the Amex cards, they give you like a $300 Lululemon credit every year. That's tax-free Lululemon swag, to claim.
Awesome. Thank you.
I'm up. Okay. So this is just I think a quick one. Do you think the IRS will phase out or eliminate the mega backdoor solo 401ks?
It's on the chopping block every year. No, IRS with the regular backdoor stuff, they have, they know it's a loophole. They've acknowledged it as a loophole. We'll play the game as long as they keep the door open. So vague answer, but I mean, who knows? Literally, it's in every single new piece of legislation, but they haven't. It never makes it to the final chopping block.
All right, Matrina, you got a question there?
Yeah, I'm next. So let's see, in 2025, I did W-2 with about 60K in 1099 work on the side. Would you suggest contributing 20% of business profit from 1099 work to a solo 401k or separate IRA? Do you recommend solo or SCP over another? Did we already do this?
Yeah, solo 401k. You'll be able to still do that. To her point, it's 20% after half the self-employment tax deduction. But then she can also do the after-tax contribution if it's the right type of solo 401k.
Yeah, I mean, wasn't that
Who's to
exact
jump through? But yeah,
It sounded
deviation of it. But yeah.
All right. The next person asked, if I'm planning on being a part-time W-2 and either part-time or making my own hours as 1099, how should I even start? If I'm younger and don't mind having less, I can put into the retirement account because I'll be investing elsewhere. Should I just start an S-Corp rather than an LLC?
So I hear this one a lot too. So I think this is the question they're getting at. You should always have an LLC for liability protection. Underneath the LLC, you have a choice. You do nothing and it defaults to a sole proprietor, pay the taxes on your personal tax return. Or you can make this S-Corp election. It's a 1 or 2 page form. You send it off to the IRS. They don't have to approve it. You're just sending it to them and they're going to acknowledge it that you're making this election. It's not something they're going to be able to say yes or no to. So it's a simple notification letter you send them essentially underneath your LLC. So if you even think you're going to do the LLC or do an S-Corp, might as well set up the LLC.
So if they created an LLC, just for clarity, and they didn't designate it as an S-Corp initially, how difficult is it to switch over to an S-Corp down the road, and is it worth it?
But yeah, it's a one page form, just has to be filed by, I think, March 15th every year. Sometimes you get some leeway on that. We've gotten approved a couple times for clients, like switching accountants. Hey, I didn't know I was supposed to do this type of thing. And you just ask for forgiveness from the IRS on it. But the deadline to file the form is called 2553. It's an S-Corp election form. You put your LLC EIN number on there and you sign it and send it in. You can always do that, at any point. Now, whether it's worth it would be dependent on, it all harkens back to that Social Security wage base.
Okay.
Meaning if you're let's say you make 100K or 150 grand in that example earlier through your W-2 job, and then you make 100 grand in 1099 work, might not make sense. You're already eating up most of that through your W-2 job. So why jump through the additional hoops?
Makes sense.
Okay, next question. Can you provide some insights into health insurance, particularly regarding the challenges in its funding and reimbursement processes? This person says that they're filing as an S-Corp and his wife is my sole employee. Currently, I'm covering the cost of health insurance out of pocket with my business reimbursing it through payroll. Importantly, this reimbursement is not subject to FICA taxes. Could you please verify if this arrangement aligns with your understanding?
Yes, that is how I would do it too. So just big shell game, right? So you're going to take because you're a greater than 2% shareholder, you have to include it as taxable income as a benefit to your employee. So you take the deduction on your S-Corp tax return and include it as income to yourself on your W-2. When you think about it, I deducted it here and I included it in income here. It's kind of a wash. We haven't even gotten a tax benefit for it yet. The benefit is, let's say it's $20,000. It's not subject to FICA taxes, but it still counts towards your fair and reasonable wage. So let's say you're going to pay yourself $150,000 salary and you got 20 grand in HSA and healthcare costs. I am only now paying FICA taxes on 130 of it, but I get to count my full wage as 150 for solo 401k and other limit testing stuff. Then, because it's on your W-2, you're paying taxes on it on your personal tax return, and then you take it as a self-employment tax deduction. So you still get the deduction. We're just literally moving it from the left pocket to the right pocket. The key to that is it gets to eat up some of that fair and reasonable wage of the 150, and you still get the same benefit on your personal return. So if you think in that example is 20 grand, that saves you 3 grand-ish in payroll taxes.
I think this question was referring to a scenario you had up earlier. It says with the S corp where you're paying yourself $150,000 salary rather than 184,500 and save $5,000 of taxes. When and how do you pay federal and state income taxes on the rest of the income, assuming you make $300,000 of 1099 income, for example?
Yep. Yeah. So 2 different schools of thought on this. We can, and it's really kind of dealer's choice. It's whatever you're comfortable with. I'm a big fan of simplicity. So we're running a W-2 payroll for you, at least in some substantial frequency. So we like to do it at least quarterly. I think it's hard to argue to the IRS. There's nothing that says, and like all tax law, there's a lot of gray area, right? There's a lot of open to interpretation. I think if you get audited, it's really hard. I know of some accountants that wait all the way until the end of the year and just run payroll one time. You can do that. But I think it's hard to make the argument to the IRS that you were working for the entire year as a CRNA and being paid a wage, but you're okay with only getting paid once a year. I mean, who would do that, right? So I think that's kind of a red flag. So we like to do it at least quarterly. It's some sort of systematic frequency that isn't, and that falls in line with our accountable plan stuff too, at least, every 90 days. So that's one part of it. The other part is when you're running your payroll quarterly, if you're an S corp, you can over withhold, not just on your 150 grand, but withhold enough taxes to cover the whole 300 grand. That's one option. Or you can withhold on your 150 through your payroll, and then you can make quarterly estimated payments. What I like to do with our clients is set it up through the payroll at the beginning of the year. That way you don't have to log into portals from multiple states and federal, setting alarms in your phone every quarter to like go log in and make these estimated payments. We just gross it up, essentially, the withholding on the W-2 to cover all the income. And we would determine that through tax projection stuff we do at the beginning of the year.
The next one asked if there are any new tax laws that will be taking effect this year that will impact us, like the higher earner people and any tax breaks that are expiring.
Yeah, so there's additional catch-up provisions. I think from age 60 to 63, you can do another 11 grand and some change as a catch-up contribution. It's got to be all Roth. That's in addition already to whatever it is, the 7,500 additional contribution. Also has to be all Roth. Other things that might be taking effect this year would be charitable deductions. So there's a floor now of 0.5%. Before, any of your charitable write-offs basically starts right at 0. Now, let's say you made $1 million on your modified adjusted gross income. The first 5 grand in charitable contributions, 0.5%, you don't get any credit for. So if you then donated 15 grand, you're only going to get to write off 10 of it, because essentially there's this 0.5% floor that kicks in. So certain strategies like bunching charitable contributions, stuff like that, can be important. The big thing that is going to benefit everybody on this call this year, and if you remember the OBBBA or whatever the acronym is, Trump's most recent tax bill last year that went through, it got hung up in Congress for so long because the major sticking point of many, but the biggest one, was the SALT cap, state and local tax deduction. So before, we could only write off 10 grand, which means most people didn't itemize on their tax return because you're not getting as much of a benefit for it. So those state and local taxes, income taxes, property taxes, the license plate renewal fees that everybody has to get, those all would count towards that limit. Almost everybody on this call is over that $10,000 limit. Now it's 40 grand. So a lot more people are going to itemize this year. And then that kind of factors into the pass-through entity stuff. Doesn't make as much sense now going forward. There's a million changes, but those would be big ones kind of impacting the call.
So you've been talking about a lot of these things, but one person was asking if you could do a comparison of S-Corp to sole proprietor vis-a-vis the mega backdoor Roth solo 401k. I don't know if you've done it specifically, if you've talked specifically about that.
Yeah, I did. So the big thing there, and I actually do have a video on it on our website or YouTube channel too, where we compared the two. With a sole, let's say you make $300,000, and I guess I can do it real quick. It's not that complicated. It's going to boil down to this key factor. How much do you want to put away pre-tax? If you go here, if you go and say, make math easy, say you make 300 grand as a sole prop, and we'll make 300K, but then you're going to pay yourself 150K S-Corp. Okay. So these are two scenarios. With the sole prop, give yourself the 24.5, and then without making this super, super complicated, 6.5, you got to times half the self-employment taxes times 25. You could do basically all the way up to the $72,000 limit. So whatever that is. Okay. So you could do it all pre-tax as a sole proprietor here. The most you can do total is 72 grand. And I'm not factoring in, over 50 years old and catch ups and stuff. That's just kind of baseline, because it gets a little more complicated there. You could do everything pre-tax, or you could do all 72 grand after tax to your solo 401k. You could do both of that in each one of these scenarios. With the S-Corp, it's only based on the 150. And that is back to this example up here. So do the 24.5 as an employee, do 25% profit sharing. The most you could do pre-tax with that salary is 62 grand. And then you could do the additional 10K as the mega backdoor Roth after tax contribution. Or you could do all 72 grand after tax here if you wanted to. The big distinction here is how much you can do pre-tax between the two scenarios. All right.
We have another question. It says your thoughts on the LTD policies.
Yeah, long-term disability is one of the most, in my opinion, oversold policies out there. I think I said this on the last webinar. No joke. I get like 10 emails a week of, I see you work with CRNAs. You mind? I'd be happy to write you a blog post or get on your webinar, and like foaming at the mouth to have access to sell long-term disability to very thirsty. Not to say that there isn't a need for it. They're very lucrative to sell. Most people, I think, are overinsured. One of the key things and the only reason I bring this up is because it's been like a recent thing with a couple of clients. If you take a deduction for your long-term disability policy on your business tax return, whether you're S-Corp or sole proprietor, the benefits that you would collect, because you're taking a tax write-off for it. When you collect the benefits, if you ever do, those are taxable. So usually what we recommend is don't take the write-off. Let's say your premium's $5-6 grand a year on your long-term disability policy. Yeah, that would save you some money in taxes. But then if you ever did need to collect on it, it's all going to be taxable then, and a lot more than the benefit that you got from the quick write-off, $5-6 grand a year. Some of these are $10,000 a month you'd be paying taxes on. So if you're going to do that, then you probably need to have a bigger policy so you're netting the right amount. There's ways to keep the costs down on these. What we try to solve for, one, is trying to get you self-insured as quickly as possible. Get the nest egg as big as possible. Bill Gates doesn't need long-term disability insurance, right? He's got enough assets to hopefully cover him. The way to keep the costs lower is to lengthen out the elimination period. So basically, the most policies work that they're going to make you wait a certain amount of time before you can actually start collecting benefits. Typically, they're 90 days, 90 to 180 days. Well, if you've got a bunch of liquid assets or access to other things like credit cards or loans or things that you could use to bridge the gap, why not extend that elimination period to a year? Hey, I can float for a year, and let's be honest, your lifestyle is going to change in a major way too, right? Your expenses, your monthly expenses are going to go way down. Well, if they know they don't have to cover you for a full year, that's going to make the policy cheaper. And then if also the benefit period, most of them default to going out to age 65, you could look at making the benefit period only to age 55 because you would be financially independent because you've been saving a bunch of money and everything to get to that point where you wouldn't need coverage all the way to 65. So what you're basically doing is telling the insurance company, instead of covering me for this amount of time, cover me for this amount of time. And that's a way to really drive down the cost of some of these policies. Key thing is just making sure it's own occupation. Obviously, you cut your hand off, you probably can't administer anesthesia, but they might not pay out because you could still work the fryer at McDonald's. That doesn't really work.
That ain't gonna cut it.
So you want to make sure they're saying, hey, it's own occupation. You can't practice anesthesia anymore. It is a key thing. And that'll make it more expensive, but that's the whole reason you're buying it. And then I would really evaluate what you need after taxes to be able to bridge that gap. It's probably not replacing 70% of your $300,000 gross income. Remember, you're paying taxes on that 300 grand and you're saving. Most everybody on here should be at least maxing out their retirement plans and everything through work. So after taxes, it's not 300 grand, even though you're overinsured and you're covered. You already have. So I'll put my soapbox away, but they're way oversold. Doesn't mean there's not a need for it. Most of the time, like I know the ones through like Henry Ford for you guys is great. There isn't really a need for additional above and beyond that.
All right. Well, that's good.
That is good to know.
It's just not affordable, right? If you left Henry Ford, then that policy is there. Then you got to go right. So that's the catch.
Right. So real quick, Ben, just last call here for questions. I know you're kind of on a time crunch and I don't want to keep you, but maybe can answer a couple more quick ones.
A couple in the chat here.
Yeah.
Do you want to answer that last one? Is there a way to deduct or expense HSA contributions or healthcare expenses as a sole proprietor as a business expense?
That's yes. Just as a sole proprietor, it happens on your personal tax return. You don't have to do anything super funky and creative like we're talking about with the S-Corp. It's going to happen on your personal return. There's actually a line item for self-employed health insurance and HSAs. It's right on the personal return.
Ben, I got a quick one too. Back to the corporate veil question. If someone unwittingly, let's say, pierced the corporate veil, paid out, whatever, or use that card for something else, is that a big deal? Is there a way to back out of that and so that you don't expose your income?
I have not passed the bar. Not a licensed attorney, like all the disclosures. There's a lot of schools of thought on this. I think the corporate veil liability is just one more kind of like CYA thing as a layer. A good attorney is probably going to be able to find a way to pierce it. What I would say is having malpractice insurance is the real coverage, right? That's what's really protecting you. Same thing with like my business. Like, yeah, I'm like very diligent about an attorney would find a way to come after my personal assets. I'd like to believe I'm doing everything but a good attorney worth his money is probably going to figure it out. But that's why we have business insurance, right? Personal liability protection. On top of that, like everybody should have an umbrella policy on top of it. You get a $2 million umbrella policy for like $400 a year. Well spent for catastrophic stuff like that.
Well, thanks. I know that was kind of out there. I just wanted to since we touched on it, I didn't know if you could answer it or not. I just figured I'd throw it out there. A couple of us at work were talking about that because I know I personally have made that mistake and I'm like, oh man, probably shouldn't have done that.
Yeah. Yeah. That's why you got the insurance is more important, but either way, I still think everybody, like in Michigan, it's $25 a year to renew your LLC. 25, you can write it off. It's $25 and you need it anyways. If you're ever going to do the S-Corp, you have to do it underneath an LLC. So it's one more layer. Do your best to have a separate business account that you deposit stuff into. Try and keep track of it. That helps just for like bookkeeping stuff at the end of the year. Everything's in one account. So every 2 weeks, my wife gets paid. I move it right from the business account to our personal account. We don't leave anything in there, but it's just one more step. Yep.
So you do that every 2 weeks. That's that's how you recommend doing it, just like a regular payroll setup?
We just don't leave anything in the business account, right? Because I mean, again, she's bouncing around to a couple surgery centers. It's not, it's not like she might have 2 expenses a year that flow through as like write-offs, right? That are 100% business use. So when we need to like run payroll for her S-Corp, all right, this quarter, I know I need to have 20 grand in there. I'll just move the 20 grand back, code it in the bookkeeping software as shareholder contribution. Payroll runs, moves it right back to our personal account.
Nice.
Because we always joke, like, I want to be Chase Bank's best worst customer, right? Like, I want to deposit a bunch of money to Chase Bank, then move it out and have it working harder for me elsewhere. I don't want to have too much in cash.
All right, I'm going to back up on the chat. I think we missed one up here. It says, can you maximum fund your solo 401k and add a SEP IRA a lower amount to?
No. It's what it is, the section 415 limit. It's 72 grand across all retirement plans. Defined contribution retirement plans, I should say, or DC plans. EB plans, defined benefit plans, are a different animal. Pensions. I have a client this year. We're going to do like $180,000 in a cash balance pension plan on top of the 70 grand that he's putting into a solo 401k. So he's over 60, and there's like a bunch of moving parts to that, but he's going to put away like 250 grand pre-tax this year.
Nice.
Is that all the questions? Anybody else out there have another question they want to ask Ben?
I'll share this. I don't know how many people do we even have in the chat here.
20, I believe.
So I'll put this up just as for folks that might want to explore working with us. And actually, I got the wrong one here. A second.
We'll be sending.
Oh, you will. Okay.
Out, yeah.
Okay. Yeah, obviously tax season, this is all top of mind for everybody. So I do not mean this as a sales pitch, like whatsoever. We do have limited capacity. So I would say, like, if you call us the day before your S-Corp tax returns due, we're probably not going to be able to make it happen. We will, essentially we're trying to decide capacity stuff, maybe like 5 to 8 more new clients, and then we're going to start a wait list. So if you want us to do your taxes for last year, book a meeting sooner rather than later to make sure you're kind of in the queue. Obviously, there's no like you booked a meeting and that's that. But we do have a QR code here. I do have a QR code here that you can scan, and we'll send out the link as well if you want to book a time on the calendar to kind of see if we're a good fit from there.
All right.
Nobody else? We got no other questions? All right, Ben. Well, thank you so much, man, for your time. We appreciate it. I think you answered a lot of questions here. I know a lot that I had personally. I think a lot of the people who jumped on the first webinar and came back, I think you literally hit all of them. So I really appreciate it, man.
Perfect. And you guys are going to send out the recording of this as well?
Yes.
Correct.
Okay, cool.
Okay.
Well, I appreciate being a part of it. And then, yeah, if anybody has any other questions, obviously, you know how to get in touch with us from there, and we'll take it from there.
Absolutely. And you can visit us at discoveryanesthesia.com to get any of your CE credits needed. Feel free to come see us. Thanks again.
Thanks, everybody.
All right, you guys have a good night.
You too.
Thanks.
Ben. Yep. All right, bye.